Hello traders and welcome to this live intraday strategy webinar. Today is Tuesday, November 15th. Michael Boutros here with you this morning. We just got the release of retail sales, advanced retail sales for the United States coming in at 0.8%, slightly topping expectations, although you did see a nice upward revision to the previous month's reads as well. Broadly, you'd be pretty supportive of the dollar, which is already continuing to press resistance here early in the session. All right, so let's jump right into price action. It's good to be with you guys this morning. Dollar has continued to press into new highs. It did close below the 2015 high day close yesterday here on the ICE dollar index. Dow Jones FXCM dollar index also closing below the high day close. We'll want to watch these intraday price spikes, guys. We really need to close above that region at 100 flat, 100.02 to get the validation for a continued move higher here in the dollar index. That being said, remains constructive while above the 2016 high day close, now near-term support where we tagged yesterday at that 99.53 level. As far as the economic data is concerned, you still do have business inventories out at 10 o'clock after the close of the webinar here, so keep that in mind. And then the economic docket as it pertains to Fed speakers. Okay, I'm going to continue to bring this chart, this calendar up, just because you really got to be mindful of when these guys are talking. Fisher will be up at 13:30. Tarullo will be up at 9 o'clock. Also, we'll have Robert Kaplan, who will be speaking in Dallas. Over the next couple of days, you still have Kashkari and Bullard on tap, Dudley, and obviously Yellen here on the 17th will sort of be where a lot of traders will be focusing the commentary. It's only important, guys, because this is the first fresh batch of commentary we've gotten post-election. And if we continue to monitor the Fed Fund futures rate, okay, look at this, 92% chance for an interest rate hike next month. If we go out a few months into March or May of next year, you can still see mounting expectations for another 25 basis point hike, starting to surmount somewhere around, let's say, July of next year. When you add these two together, you start to get above 50% is when you expect the next interest rate hike. So what I wanted to just take a step back is, you know, markets are largely pricing in this December read. We've been talking about that for weeks. The more important thing now is that the markets are starting to price in the future glide path of interest rates. Okay, if we take a look at the dot slope or the dot forecasts, here's the dot plot for the Fed interest rate expectations. What you see in green is where the Fed expects interest rates moving forward. So this is what the Fed's outlined expectation is based on the last quarterly projection that we got and the Fed interest rate dot plot. Okay? As of the meeting or as of the data, you're still down here. Where the market is pricing in, the latest value of the OIS, the overnight index swaps, is right in the middle. So you can see that there's still room for this to move higher towards where the Fed is actually marking expectations for interest rates. That should keep the dollar broadly supported. Doesn't mean we can't get mean pullbacks, reversions, corrections off the high, but it certainly suggests that they're still being priced in as far as now the future glide slope of interest rates, not just the next imminent hike, which is already priced in now to December, but the markets are starting to bring up those further out interest rate expectations, and that I think is what is the theme, the underlying move here that we're seeing in the greenback. So I'll continue to bring this up, guys, during the webinars when I see it relevant. The recent shift I thought was worth taking a look at today, and certainly with the overnight index swaps and Fed Fund futures now starting to really surmount high expectations, the risk becomes twofold. Any deviation from the expectation of higher rates and or weaker data. Those are the risks that could really sort of derail the near-term rally that we're seeing. That said, the focus on the dollar index, as far as the ICE dollar index is concerned, is still going to be that 100.02, the 2015 high day close that we made back in December of last year. We need to close above this to really validate a much more concerted breakout, let's call it, in the dollar index. All right, while below that 100 spot, use caution. Eileen, good morning to you as well. Glad you still give your thoughts in this tricky trade environment. Smiley face. Well, that's our job, and we're always going to, there's always an opportunity somewhere, Eileen. We just got to know where to look, right? I'm actually still short pound yen from yesterday. I wrote that in the report, guys. We'll go over that in a moment. I also do have setups on Aussie Key we want to review, dollar yen. While we're covering Aussie Key, we'll jump into the Aussie dollar and Kiwi dollar, which are of interest for me. Specifically, Kiwi still at support. Obviously, the euro dollar highlighted last night. We'll touch base on British pound. Gold, silver, and crude all got updated on the radar charts, guys, on the intraday page. So take a look at that if you get a chance. And as always, questions, trade setups you guys want to review, feel free to throw them on the message board. Adam, good morning to you as well, sir. I'm doing well. Eileen says, by the way, an historic question, maybe when you get a chance, wondering if you can look at any new signals now, or if you look at any new signals now that give you an additional clue to try to trade. Eileen, I'm not going to lie to you. My major, the thing I consider the most is price action, more so than any oscillator or any signals. But we'll go through some stuff today. I'll show you what I'm looking at. As always, guys, feel free to throw out any questions or trade setups you want to review. That said, let's jump into yesterday's update. So, pound yen, you got the release of CPI numbers from the UK this morning, weaker than expected across the board. I really wasn't expecting them to take quite that big a dump. Here's what the UK data looked like overnight. You had CPI coming out at 0.1% on the headline month-on-month read. That's a expectation miss for sure. We were looking for 0.3 and a downtick from the previous month. Same on the year-on-year. More importantly, core. This is really what central banks are focusing on and targeting as far as their inflationary targets are concerned. What I can say is this. A 1.2 print is definitely not what the BOE wants to see. You saw the sterling pull over an overnight trade. We were already short, as I noted last night. Here's what sterling looks like right now. Let's start off on the daily chart. Here's what pound yen looks like. Okay. Here's where we were yesterday on the daily. And I was just highlighting this major key region, 136.18. I still think, and by the way, it stops our break even, so if it comes back and it gets me out of break even, no big deal. But I still think you can get a rally, an unexpected rally, for a move into 136.18. I don't want that to happen, obviously, I'm short, but that's sort of the major barrier thresholds. The key 618 retracement of the entire decline from the post-Brexit rally. Okay, it's also basic slope resistance. So if we take this one basic trendline resistance off the high, sliding parallel off the low, got nice pivots there, caught that high. Take that same slope, sliding pivot off the low, caught that low. Messy, but it caught that low. Here's the resistance confluence. Add to that basic trendline support off the lows, extended off the low from here, resistance, also in this region. So the premise of the trade and why we took the short is just a near-term exhaustion spike into that trend line. Like I said, 136.18 still being the sort of major key barrier. If it rallies back into that region, I would be looking for another short entry. I took a little bit off this morning at 30 pips. We had another opportunity to take off at 40. I didn't do it, but it's still in the money at this point. I guess here's the live position. So here's where we jumped in yesterday. Wasn't really happy with the entry, to be quite honest with you, but I saw it start to break down in early Asia trade. So I just wanted to be short. We were near resistance. Again, my limit is down here at 134, guys, and that's this region right here. Excuse me. On the intraday chart. Here's what it looks like. That's this region right here. Just below the monthly open. Basically the opening range low for the week. So I literally came like 11 pips off from being triggered on the limit and overnight trade. That being said, stops are at break even. If we get stopped out at break even, no big deal. We're still about 26 pips up. If it blows through the highs, again, I'd be looking for resistance up into that 618 retracement, confluence resistance with former parallel support, now resistance. So the idea for the sterling is inevitably I still want to try to get on the long side of it. But I do think near term, you're still at risk for a little bit of a drawback here into that key support pocket. Again, this is the Brexit swing low. This is a 618 retracement from the decline just off the near term, off that September high. Slope support. There's a lot there. So we'll see if this breakdown can't get me a little bit more on a deeper move to the downside here in pound yen. And this region right here, interestingly enough, coincides with that swing low, but just lower at that 132.28 is that former trendline resistance. And you have the 50-day moving average. So this whole region, and this is why we marked 32.28 as our near-term bullish invalidation level. So as long as we stay above this, I'd actually be looking for an exhaustion low into a drop into one of these regions. A breach above 36.18, all bets are off. You're looking for 37.23, you're looking for 38. The high day close should be a little bit bigger of a marker there, followed by 39.28, which is just a basic fib. But near-term risk is for a pullback before we continue higher. Questions on pound yen? Again, a wider range ATR. I do want to just remind everyone in the room, if you're still newer to the strategy, might not be the best pair to get involved with. Again, a quarter of the daily ATR is still showing about 45, 46 pips per scalp, so a little bit bigger of a range, but also a little bit more forgiving as far as where you can put your stops on it. So we'll see if we can't get re-entry here on pound yen. Steve, where did you say the support for pound yen is again? So Steve, as far as the support, interim support is still down here. Well, let me say this first. Initial support, what we're rebounding off of right now, is actually the weekly open. You see those gray dots? Literally caught the lows that we just made. Okay, so initial support is right here. You could see a little bit, like I said, a vault back into 36.18, but the risks for a pullback below this region. I would like to see a little bit more of a strong support hold into the 33.20, 33.46, this zone right here. Does that make sense? Bullish invalidation, Steve, is down here. So even on a spike, if we were to hold 32.28, still want to hold it. If we move sub 32.28, then you're looking much, much lower. This is sort of the threshold. Make sense? Yes, thank you, says Steve. Yeah, more than welcome, sir. D, can we look at euro pound at some stage? I have a big position today and want to see targets, please. You got it. Euro pound. Great British pound. You got it. Let me go over pound dollar first, and then we'll jump into euro pound, okay, D? Here's pound dollar. This was covered earlier in the week. I just want to kind of take a quick segue since we're here on the pound yen, sticking with the theme. Here's what pound dollar looked like to start off the week. So we noted the risk for a little bit more of a pullback here off of this false resistance, or false breakout that we made of this near-term formation on Friday. Here's what the pound looks like right now. Obviously, you saw that pullback really start to materialize a little bit deeper once you got the release of those CPI figures. Let me bring this into a 2-hour chart. Okay, so the levels haven't changed. Levels haven't changed from where we were to start off the week. The risk was to the downside, sub 26.06, 25.34 was the initial sort of support target. Then the low day close for 2016, which converges on a basic 38.2 at 124.47, 124.33. We just broke below that, and it's now near-term resistance. This is what I'd be looking at. You see this 50 line? You see some nice pivots along that. That's just below the lows we made right now. Key support is down here at 123. So on the back of the data that we got, I wouldn't be surprised to see sterling get that low. I'm still constructive while within this formation. I still think we want to be looking to buy this pullback. But as it stands, I'm looking for signs of exhaustion. Momentum is sub 40 for the first time in 2 weeks. Here's the momentum signature. Here's the last time you were sub 40. Okay, it's been 2 full weeks, and it's Tuesday of this week. Looks like we're looking for a break below 40. So it suggests maybe have a little bit lower to go. And again, I'd be looking to inevitably buy that pullback. If you're not already short, I don't have anything here for me on the short side. More so, I'd be looking for that pullback deeper to get on a long position, especially some short pound yen already. I don't want to double up on the sterling positions. What would put me constructive again? Just thinking out loud here. Well, I need to see a break back above that median line right here. So move above 125 essentially is what I would need to get back on the constructive side from the immediate approach here for sterling. That said, do think you can mark one more low here before starting to make a little bit more of a concerted rebound. Irvine, great to see you in the room, says, do you have SMS capabilities on signals? So Irvine, you can actually set up SMS signals to go right through with the hashtag trade whenever Jamie or myself post on SB Squawk, and that'll go straight to your phone. Keep in mind text message fees apply for whatever carrier you're working with. But the instructions for that are right on the website. So Irvine, just click on the home page, and under right here, SB Squawk sign up form, you'll see right here setting up the SMS alerts through Twitter. Okay, so click on that link and that'll take you to a page that'll sort of walk you through the process of how to do that. Right on. Welcome aboard. All right. Any questions on pound dollar or sterling yen? Sterling yen was number 1. Pound dollar is number 2. And let's jump into a segue real quick. For D, I wanted to look at euro dollar, and then we'll jump into euro pound. So keeping the mindset here that sterling could see a little bit more downside to go before we start to reverse near-term resistance 24.47, bearish invalidation 125, key support of 123, 123.10. Here's what euro dollar looks like. And this is something that we highlighted yesterday. So here's what euro was looking like last night. The basic premise of this trade, and certainly the thing I wanted to highlight the most, was where the daily chart was and where we came off of. So the 2016 concerted low comes in at 107.07. Okay. I think I'm a couple of pips off here. What's the low? 107.08. 107.11. In any event, basically 107.08. Yeah, this is just a bit off here. Sorry about that, guys. And basically that's where this thing capped out and saw a really strong rebound. The basic thing I wanted to highlight yesterday, and it kind of, I guess that trade has already panned out and is done, was the fact that you were marking some clear-cut divergence into these lows. These are decent divergence signals, especially when the gap is so big. Much steeper low in price, equal or higher low in the oscillator, okay? And then a 60 break, or a 40 break rather, to the upside really suggested that you might see a little bit more recovery. Near-term bearish invalidation resistance was 108.22. We put a high in at 108.17. Okay, so we just missed that, and here we are turning lower. That might be the extent of it. I don't know. All I know is that that was a really clear-cut area of support, aside from it being the yearly low. If you take a zoom out here, bring this to a 4-hour chart real quick, you can see basic slope support. This is the slope, the origin. All I did was take that slope, extend it off the low, take that slope, extend it off of this low and this low. And you can see nice confluence region there with the previous January 2016 low. So there was some reason to believe that we would get a rebound off this. The rebound has sort of played out. We just turned ahead of resistance, and here we are back on our way down again. This remains key support for now. Okay, I do think you get a stretch into 106.61. That would just be, I mean, I guess from a technical standpoint, it would just be a really clean move. So this would be the extension of the decline off the highs. Okay, boom, boom, boom. 2 equal legs down. Excuse me, 100% extension takes you exactly to 106.61. Okay, the daily chart. What would put me constructive on the euro? You'd need to see a topside breach above 108.72. Again, that yearly open, which was a clear-cut pivot in price over the last couple of months here, and converges on the median line. All right, so long story short, guys, for the euro, I think you could see a little bit more sideways to lower action, looking for an inevitable drop into that 106.61 barrier and a reaction there. If that does give way, there's really nothing left on tap until like 106 flat. Nice trend line confluence down there. D, you got that? Next support level after 106.61 is the 106 handle. So this is what I'm looking at. This is a basic trendline support off the low that you made in 2015, specifically in March, tagged again in December, and that comes in right around the 106 handle. 105.95, 106, right down here. Make sense? Other analysts calling for 103. Yeah, I mean, look, again, D, so we have to keep in mind what our objective is. Our purposes here in this specific webinar is near term. What's happening right now in price? For me to be looking for a 400 pip move right now, sure, I don't know. It could. But all I know is what's the upcoming imminent support, and that's my job, is to tell you exactly what's coming up right now. And right now, you have a 107.10 and 106.60 as levels of support that you would need to get through before we even start talking, you know, anything sub 106. You know, I'm not much of a, I don't really hold positions for that kind of duration where I'm looking out that far. You have interest rate expectations, which are shifting all around. You have major central bank interest rate decisions, which are on tap. And who knows? So first things first, look at these near-term support targets on euro. And D, I don't want to shake you out. If you guys are looking for positions that are more longer term and you're looking to hold them, I don't want to be the one to shake you out. You know, Jamie's midweek strategy webinar tomorrow is the kind of place where you want to throw around these ideas for longer term, broader scope. I do think that the dollar is going to remain pretty well supported, D, in any event. But I hope that's some fruit for thought there. Are there 30-minute charts still of any use? Eileen, yeah, 100%. I'm still looking at 30-minute charts. I've stopped really publishing 30-minute charts very often just because I've heard a lot of feedback from you guys saying that you really enjoy the longer-term charts or the more zoomed-out charts because you get a better idea of where, you know, where we are in structure, where we are in trend. So the strategy in and of itself per se hasn't changed. You know, I still do go drill down into the 30-minute charts, drill down to the 5-minute charts for the execution. But for the sake of publishing, I've just been giving you guys a little bit more of a zoomed out view. Neder, can you please tell me where to sign up for the SMS text? So Neder, if you go to sbtradedesk.com, click on the homepage. I'll send you the link right now. Here's the link, buddy. I sent it to everyone, okay? Whoops. Okay. Okay, so moving right along. You're more than welcome, sir. My pleasure. Don't forget dollar yen, says Horace. Oh, goodness. How could I forget dollar yen? No, it's on the list. It's on the list. But first things first. So for D, we talked about the sterling, right? Maybe a little bit more downside to go, but broadly looking for support. We talked about euro, basically sitting at support. Here's what euro pound looks like. And we went over this briefly yesterday. I'm not sure if it was with you, D, if you were in the Daily FX webinar yesterday, but basically the break below 88.15 really changed things. And the outside day that we made off that region, where we came right back into the monthly opening range high, failed miserably, then continued through the monthly opening range low, objectively, irrespective of what Mike Boutros, Jamie Setley, Daily FX, anyone thinks. It's an objective break of the weekly opening range and does of the monthly opening range, excuse me, and does shift the focus lower. So how low do we go from here? Well, we broke back below that key barrier of 87.09, 87.38. If you guys recall, we were talking about this for months, literally months. not only because of the Fibonacci significance of it being the 618 retracement of the entire decline off that 2008 high, but it was also 100% extension of the entire ascent off the 2015 lows. Huge pivot and major significant Fibonacci confluence. Add to that basic slope resistance. So this slope is derived from these two peaks, which caught these three peaks. And here's that peak with a really nice test, break, back below. Okay? Does leave me looking lower still, while below basically 87, the 88 handle. This region here, D. What's 88.15 marking? 88.15 marks the high that we made back in 2013, specifically in February 21. Questions on this chart? I can see the gears turning, Eileen. What do you got? How to know when those types of highs are significant? Listen, Eileen, any multi-month high is going to be something you want to act and target as at least a soft target on your charts. Does that make sense? This is a multi-month high. Again, bring it out to the daily chart. It'll be much easier to identify if I can get my... It'll be much easier to identify. So I typically have these magenta lines for the yearly opens. So obviously, specifically on this one, Eileen, why it's important is because it's actually a yearly high. It's not just a multi-month high. It's actually the 2013 high. So let's go ahead and just do this as a quick drill. Here's your 2014 open. Yearly open. Here's your 2013 open. Okay, so it's a concerted yearly high. It's a multi-month high. It is a tag or pretty close to of resistance, and you can see again right now it converges on that former upper median line parallel. So near term, I think, again, even if you get a stretch above 87.40, which is near-term resistance right now, 87.40 into the 87.10 level, this is still near-term resistance. This is near-term bearish invalidation level, more key support at this point. Bear with me. Now that we've made this move here, let's see what a basic retracement off the high looks like. Off the low, rather. Bear with me one sec, guys. And then one other thing we want to add, the 38.2 comes down here with a whole host of stuff. But one other thing we want to add is an extension. Bear with me one sec. Let's see what this looks like. Woo. That 100 comes right in line with where we are right now. And look at that 1618. That's the one to pay attention to. Right here. Let's see if I can clean this up anymore. I do want to leave these gray lines here. We can get rid of this 50. Okay. So this are the levels I'd be looking at. D. Took shorts after yesterday's Daily FX webinar overnight at 87. What's the target? Nice play. Nice play on that, D. Yeah, we were talking about this yesterday. It was you, right? Awesome. I'm glad that you acted on that. So the next target to the downside, I'd be looking for basically 85, 84.91, D. You have that 1618 extension, and more importantly, it converges dead on with that median line. Okay, this is the low that you made in, what is that, August of 2015. The subsequent high that you made in, what is that, October, and then the subsequent low in November. We were in this formation for a very, very long time. It got really messy back here in July and August. I completely recognize that. But that same median line, which has offered resistance, support, support, resistance, support, converges on a basic 1618. Just below that, a basic slope support off the lows there, which could be in play. I don't know if this is going to be significant per se. It's only a two-point touch, but that gives you a range basically of like 84.50 to the 84.90 level. Near-term resistance 87.40, bearish invalidation 88.15. Does that make sense? D, let me know if you have any other questions on pound, on euro pound. Eileen says, sorry, feel like beyond a rank beginner right now. No offense to the real beginners. No, Eileen, no worries. No worries at all. You're in the right place. We're here to build you up, okay? Michael, thank you for yesterday's archive. Long in crude from 43.94, but don't know how to play silver. Your guidance. Conwell, we'll definitely go over all the commodities. I have updated all the radar charts that are on the intraday page. Kelly says, not trading as much right now. Took a long sterling yen, which I'm still in at 130.56. Thus, I am just riding it. I'm glad you go over it. Thanks, pal. Hey, you're more than welcome. Yeah, pound yen. I also got an email from someone in overnight. I'm not sure who it was. The intern sent it over, but there was a request specifically on pound yen, which is why I put that in the report last night. It's kind of like, seems like a lot of you are very interested in what that thing is doing right now. The Dragon and the Widowmaker, it's called. So make sure we're playing with our leverage and using that appropriately. All right, it looks like I'm out of pound yen at this point as it continues to rip higher. So we took a break-even stop there. We'll see if we can't get another opportunity to get back in on the short side, guys. Levels unchanged, okay? Look at the U.S. Open. Look for those highs. Now 136.18 level. Not sure we get quite up there, but I'll be interested even at 135.50 again to start looking for some triggers in momentum, okay? And that's one more thing, guys, that we don't really talk about enough in the webinars, but I feel like all of you should be very comfortable taking break-even stops when we're intraday trading, okay? Especially when you're playing these swings and you're fading a rally. You don't want to get too aggressive, guys, especially in this environment. We just passed through, you know, major volatility with the elections. Markets are still digesting a whole boatload of data. So, you know, be quick to put those break-even stops. I know it sucks. No one likes taking break-even stops. No one made money or, you know, got rich taking break-even stops, but we have to be on the defense at all times in this kind of market condition, okay? Especially when the breakouts don't last. You get a lot of reversals. You get a lot of moves that just fade. So, you know, play it close to the chest in this environment. I got no problem taking, you know, 4 or 5 break-even stops. It doesn't matter to me. When we do catch the move, we'll be in heavy and we'll be looking for a much larger swing. Okay, I think I am up through all these questions. Upside move. Do you think we can see some upside movement to close the weekend gap? Steve, did I miss that question? What was that on? I think that was on pound yen. No, that was euro dollar, he says. Kelly says, that is great advice. Save your pips, people. Yeah, I mean, it's just best to know, Kelly, when we want to be pressing trades and when we want to stand back. And that's something I think retail traders forget to do a lot. A lot of times, we have a strategy, we have our discipline, and we just kind of like go through the motions. But there are times when, you want to be a little bit lighter on your leverage, and there are times where you want to be very, very close to the chest as far as your risk management. Because I don't know if this is going to be the high. It could stretch into 36.18. No point in me putting a stop above 36.18 and sitting up, sitting through that 50 pip rally against me. I'll wait till it gets 36.18. If it does, great. That break-even stop, well, at least we booked 30 of it, and that's the way you want to play it, guys. Very nimble until we get some of these major levels cleared on some of these trades. All right, so Kelly, are you good on that? 30.56. You're still holding a really nice long entry there, right? From last week, or was that earlier? That was earlier this week, or earlier last week, rather. So watch that 35.51 and watch that 36.18 level. Both levels of interest for you as far as the long side is concerned as resistance. Right on. Keep up the good work. Well done. Okay. So Steve, on Euro, I do, after this turn, Steve, look, this is what I want to say. On the initial approach, if we didn't make it to fill that gap right now and we're turning, you're still looking for a drop into support. This could be a breakaway gap. I think inevitably it does fill, but it could drop down, to that 106.60 level first before it fills. So don't let that gap being uncovered be the reason that you are necessarily bullish Euro. Okay, we were bullish Euro yesterday because we came off support. You had divergence in momentum. You could have seen a swing up to 108.21. Again, we just turned ahead of that, right back on the way down again. The gap fill, wouldn't necessarily be the reason that I want to be long. It's whether if we get another support divergence and a trigger break into this region, sure, Steve, it might be a decent long entry again. But again, I wouldn't even be targeting that gap until we get through 108.21. This is still a pretty big region of resistance for me near term. Former lows, former slope support, now resistance. Current operative, descending slope, now resistance. Okay? Says got it, thank you. You're more than welcome. Good question though. And the way I like to play those gaps is typically if you gap open into the Sunday, or you gap into the Sunday open, and if that gap is into support, typically the gap fill is this play right here, Steve. So the fact that we failed miserably and turned and had a pretty clear reversal there does suggest that a gap fill is maybe not on the books here on this immediate approach. Okay. Oh, man, I think I'm losing my order here. So let me go back. Sterling, we did Euro after that. And then we did number 3, pound. Okay. Let's go back to Aussie Kiwi real quick. So we went over pound yen. Here's what Aussie Kiwi looked like yesterday. And here's what Aussie Key looks like right now. Okay, the major thing that you want to keep in mind here for Aussie Key, nothing's changed. 106.62, 106.55 key resistance. You have the monthly open just ahead of that at 106.40. The 50 line of the current operative slope off the lows. Lots up here. I guess I should just highlight that 107 is the near-term bearish invalidation level. Let's say there's a whole boatload there. Aside it from being the objective monthly opening range high, you have the 200-day moving average, which slides right into that level right here, and you have the upper parallel for the current operative slope that we've been in off the highs from 2015. So there's certainly a ton of stuff right here. Both at 106.60 and then again at 107. So these are the major 2 resistance targets. You're at risk for a pullback off or ahead of those regions. Here's what it looks like on the intraday chart. And again, there's that key region. Even on the near-term approach, guys, not only do you have that monthly open, but keep in mind, basic 618 retracement. Oh, I stand corrected. It's going to be a 7. Sorry, didn't have that new low in there. All right. So, and this is correct. Okay, so 106.70 into 106.62. We'll offer that as our near-term resistance. Again, the 107 handle being essentially that upper median line parallel. Basically looking for exhaustion into this region near-term for a pullback. Inevitably, would love to buy that pullback. So if we don't stretch higher and we just break down from here, I'd be looking for long entries near the 105 handle, near 105.40, this region here and here. Both areas of interest for possible long exposure. Bullish invalidation. Oop, that's not what I want to do. Is down here. We break below basically this slope support, which coincides on the 618 and those former swing lows. That basically gives you like 104.75, 104.70. I think that would invalidate the broader uptrend that we're in. But that being said, looking for an exhaustion high to possibly pull back, looking to buy that pullback for a much more concerted breakout. As you might have read, if you guys followed Jamie in the swing update from yesterday, you know, the broader implications for Aussie Kiwi are for a massive multi-year head and shoulders formation that could basically explode to the upside for one of the largest moves that we could see here, to the degree of this, what we saw, you know, post-crisis there. So the implications are there. It's way too early to tell still, but even on the near term, sort of the momentum signature on whole has been very suggestive, that you're seeing this thing basically put in some sort of rounded bottom here on the longer term play. Questions on Aussie Key. Looking for weakness, looking to fade strength while below the median line, ultimately looking for a move towards 105, 105.40 for possible long entries on Aussie Key. All right. So again, the only adjustment you want to make to this chart here, guys, is just that 618. Other than that, levels remain unchanged. Okay, moving right along. Dollar yen. Here's what the dollar yen looks like to open up the week. It's very, what's the word? Here's what we want to say about dollar yen. Look, I played the yen strength, as I noted yesterday in the piece. Looks like we were going to get a yen pullback. I played that through pound yen. Dollar yen, the 109.13 barrier is still something that, oh, I guess we're almost there right now, 108.88. This is a 38.2 retracement, long dated, okay, off the highs that you made from 2015, specifically in June. Also, you have a sliding parallel there, which looks to coincide shortly here. Let me make that the 50. Shortly on that 109 level, 109.13. Okay. What could we say? 107.81, 107.50, this region was key resistance. The fact that we broke through it, tagged it as support, and moving into a new high keeps the focus higher while above 107.50. Okay, that's the high that you made for July. Right now it's the median line, dead on. And former median line resistance. Now support, all coincide here. So for dollar yen, it's in overbought condition. I don't want to be the fool trying to call a high on this. I'll be looking for a reaction near 105.13, 109.13 rather, near that parallel right here. I'll be looking for a reaction up here. But if we get the pullback, test, and failure, that might be the signal for a little bit of an exhaustion play. End of story. Long story short, you need to get below 107.50 to get validation for a near-term pullback as deep maybe as 106, if not the monthly open, 104.80. But basically, you're looking for signs of exhaustion near term. If you're long, 109.13, 109.50, areas of interest to take off some of that trade. If you're looking for fresh opportunities to get in this, look for some near-term divergence, look for some exhaustion heading into that handle. That is dollar yen. Questions on dollar yen? Okay, we did euro, we did sterling, Aussie dollar. Ooh, we're getting the break. We are getting the break. Hallelujah. Finally, this thing's making a move. Okay, so we opened up the week talking about the fact that we were sitting at slope support, right? You guys remember this yesterday? Major slope support for one of the cleanest plays on the dollars that we've had in all the majors. So there it was. You have the 764 retracement, slope support, the lower median line parallel, all in this little region. Don't forget, you're still not out of the woods just yet. The 200-day moving average is at 75, basically 75.10, and a break below that really opens up a much steeper decline, targeting 74.54. More importantly, the 618 retracement down at 73.80, which converges on that 25% line right there. You stay bearish below the monthly open. No change to any of the levels that we noted on the scalp report for Sunday. So here are these levels. Here it is. All right. So no change to any of those levels. We basically were looking to stay bearish. Below 75.70 was the initial resistance. That actually did end up being a really nice cap. You can see that even the stretch high that we made here was a perfect tag of that median line before turning off. And this, my friends, represents a break of the initial weekly opening range. Remember, 75.13, 75.10, you still have that 200-day moving average, which is what you're sitting on right now. So I'm going to stretch the weekly opening range into this level right here. And again, look for a break of this range. You're bearish below the monthly open, 76.08. A downside break, you're looking for 74.80, 75.50. Questions on Aussie dollar? Be cautious here because the dollar is at resistance already. Remember, it's pressing. It's trying to get through those high day closes. As I noted earlier, here's the dollar, the ICE dollar, the Dow Jones, FXCM dollar index. High day close, 100% extension overlap. Like we said, there's the yearly highs. DXY, there's the high day close for 2015 that we failed to close above. Watch today's close. Okay, so if both of the indices close above those resistance levels, I think Aussie dollar is really primed for that break of support, and you look for a drop into subsequent support targets. Okay, if we get a massive fake out like we did yesterday and both of those indices pull back below support, look for a fake out here, which could charge a near-term rebound. So I'm flat on Aussie. I want to be short, but not really. Can't really justify getting short at these levels from here unless we see a more concerted break of support. Keep in mind, at its face, it's also making an outside day reversal candle. These tend to be more beneficial when they're at the extremes, meaning if we were rallying and we made an outside day reversal at the highs. But a sell-off, making an outside day reversal into the lows, could be a near-term exhaustion play, which is why for me, I'm really weary of the Aussie cross right now. I kind of want to see the opening range really give out, and that's basically today's candle. Okay, broadly speaking, you're still bearish below the monthly open. You need to clear this near-term range here to get the go-ahead. Questions on Aussie? Number 7. Next up on tap is Kiwi. Can we do Kiwi? Gee, you got me right on tap. Can we do Kiwi? I'm in the market and want to see if my target at 70.35 can be hit or I need to change my order. Short average is 71.60. D, let's take a look. Here's Kiwi dollar. So your average entry is 71.60 is right on point. You're in the money. I would be short, or I would be looking to maintain a short buy sub 71.50, which is the monthly open, and would necessitate, a break back above that upper median line parallel. So I would like to stay bearish below 71.50. There's another reason for that too, D. The fact of the matter is that this was the objective November opening range low. So here's your November open. You stretch into a high. You don't really have an opening range high until the 8th here. You pull back. You break through the monthly opening range low. And lo and behold, the last 2 days, that's been resistance. So I would stay bearish below 71.50. Near-term support, I'd be looking into 70.50. But just ahead of that, you have this faint line here. You see this trend line? Just a basic tag, 3-tag point touch. And that basically gives you support at like 70.65. So 70.65, 70.50, the first area of level of sort of near-term support I'd be looking for, D, here on this Kiwi breakdown. Also, you have the weekly opening range low, which is there as well. Here's what it looks like on the near term. Yeah, you're probably just looking for a tag of that low, right, from back here in October. I see the thought process behind it, but the only thing I want to highlight is a basic 38.2, and this is a basic 38.2 of the entire advance, D. Let me take a step back here. Watch. Okay, this is the daily chart. This is a 38.2 retracement of the entire yearly range. That's significant. Okay, that's significant. I tend to pay attention to those. Not only that, but there's a couple of things at 70.50 that to me really stand out. A, it's the close low for October. So if we come right here, the close low was made right here on the 11th, and that close was exactly 70.53. And add to that, look to the left, your April and May highs. So, I'm not saying this is necessarily going to be the floor, D, but into 70.53, if I was personally holding short exposure, I'd be looking to take some off. Make sure your stops are at least break even or better at that point. And then your next downside target beyond that, I wouldn't even mind that low, to be honest with you. I'd be looking for the 200-day moving average, which takes you down into the 70.20 region, 70.15 right here. So just some food for thought there, D, on Kiwi dollar. Does that make sense? We'll change now to 70.55. Thanks. Yes, stops already at cost now, 71.60. Many thanks. Hey, D, you're more than welcome. Nice entry on that. And again, don't forget, D. Also, we have the option, and something I do a lot, guys, is be dynamic with your leverage. It doesn't need to be an all-in, all-out scenario. In fact, very rarely am I all-in or all-out unless I'm playing a really well-defined range, right? I always want to leave a little skin in the game. I always want to make sure that as soon as I get a quarter of the ATR, I'm doing something. I'm taking something off the table. I'm putting something in my pocket. And then, play with your stops and leverage accordingly. But always, keep that in mind as an option too. Maybe like shave off some at 70.53, bring your stops down to that swing low at 70.70, and see if you get the stretch down lower. There's a lot of different ways we can exit a trade, but hope that helps. Okay, so that is Kiwi dollar. And we went over Aussie dollar. Quick look at the com block before we wrap the session up here. Here's what gold, crude, and silver looks like. Conwall for you. Gold. Well, the thing I wanted to highlight on gold, and what is highlighted certainly on the radar charts, is the weekly chart, and that's really what I want to kind of keep an eye out here. Let me bring that up. Here's what gold looks like on the weekly. Okay, really important in that this is actually, if you go to the previous radar chart, right here, this is what gold looked like earlier last month. Okay, we were talking about 1234, 1210 as the bottom end of that range and a confluence region with the median lines. Bearish risk remains sub 1302. Well, this thing ripped. Couldn't clear 1303, 1302 on a close basis, but certainly look where the rally capped out right here in this pocket. Again, elections, crazy, radical price action, and then look where we're slamming down lower into now, right here. So the updated radar chart from last night really just is highlighting this key support region between 1203 and 1210 as an absolutely paramount region of support. I mean, if this thing gives out, you're looking for 1171 and you're looking for 1120. Very, very simple. I also wanted to highlight that momentum on the weekly basis is now testing support at 40. And if we're going to see a rebound, well, this is kind of the first area you'd start to look for a possibility of seeing a little bit more of a bid here for gold. So again, we don't want to be calling the low. We don't want to be sitting here getting long just yet. I do think you can stretch into 1203 before all is said and done. That would complete 2 equal legs off the high. Boom, boom, boom. 1203. And if we get a dip into that region again, that's an area of which you'd start to look for a little bit more of a concrete rebound. Initial resistance, 1255. You're still bearish sub 1303. Questions on gold. Again, here's what the daily chart looks like. Very similar. Key region of support. All right. Moving right across to silver. Here's what the silver trade looked like. And again, here's silver on last night's radar chart. Basically, you know, resistance is right here, eyed out at 1720. You want to stay basically bearish. The broader picture stays bearish up to 1785. No change. Remember, this was a big, big level that we were looking at basically all of last month. Finally broke on the 1st. But here's your November opening range. And here's the break below not only the November opening range low, but the November open. And all of those coincide at 1285. So I'm looking lower, and I'm looking for a stretch into 1635, 1651. You know, again, a major area of confluence support and Fibonacci levels, of which could be a little bit more of a concrete near-term floor for silver. Okay. Conwall, sir, is there a problem? I can't see your charts, so please speak the levels and archive the video. Thanks. It'll always be archived 100%. Guys, is anyone having problems seeing the charts? Just want to make sure we're all good on the audio video. Okay here, Trevor. Thanks, man. Eileen, thank you. Henry, okay, cool. Looks like it's just an isolated problem there, Conwall. So Conwall, near-term resistance 1740, bearish invalidation 1785, key near-term support 1651, 1635. That slope, that whole cushion area of support is pretty big in my book. Okay, Pooja, thanks, I appreciate it. Last but not least, from last night's radar charts, we did gold, silver, crude is what we're looking at here. We did talk about this yesterday as well, coming off a real nice area of support. If the chart wants to come, there we go. A 764 retracement caught the lows exactly at 42.18. Now that happens to also be this trend line, which I think someone pointed out here in the webinar yesterday. This is just off the lows from March, April. And you're seeing a slight rebound here. Not surprising. Really nice divergence into the lows and momentum, followed by a trigger break. And I noted that yesterday in the momentum profile, you saw that really clear trigger break here. So yeah, not surprised to see the rebound. I do think it can get quite a bit higher, by quite a bit. I mean, just that. So the close here is 45.30. Would be a first area of support I'd be looking for, followed by 45.90 into the 46 handle. It's a 38.2 retracement, basic off the highs. 100% moving at 100-day, moving average, and there's the 50 line for the current operative slope off the highs. More meaningful support down at 41. Okay, big level, not just on account of this swing low. That's nothing. It's really on account of the longer term and near term median line confluence. So you guys know this formation. You've all seen this before. Support, resistance, support, support, support. Right there. Median line off the highs converges on that same level with that swing low, 41. So levels are pretty clear on crude. I just think near term, the immediate risk is for this rebound to gather a little bit more pace to the upside. Inevitably, you want to look to sell that risk, or sell that rally rather, well below 46. Questions on crude? Hey, Conwall, you're more than welcome, sir. My pleasure, as always. A quick touch base, guys, on Aussie CAD. This is a trade that we've been following for quite some time. The reversal panned out like a charm, okay, and it continues to come off now, looking for that drop into key pocket support initially at 101.20/44, this region here. Subsequent key support and broader bullish invalidation where I would like to start to look for some long entries right back at the yearly open, 10060 here into 10070, okay? Slope support, former slope resistance, yearly open, current operative lower parallel, all right here. First things first, though, this is what you want to watch as support. Okay, the Aussie CAD levels from last week remain unchanged. Here's just a near-term picture of it. And again, highlighting that near-term confluence lower down near that 10070, 10060 level. All right, so an interesting trade we've been following. Again, just wanted to bring it up to your opinion, to your attention. Guys, that wraps us up for today. U.S. Open is, or the U.S. markets are unopen for 2 minutes now. We're going to wrap things up here. We'll be back online tomorrow morning, 8:30 Eastern, for another intraday strategy webinar. Till then, best of luck trading, guys. Keep your eyes on the commentary coming out of the Fed speakers. Like I said, there's still 3 speakers a day for the next couple of sessions. And they're just likely to spark a whole bunch of volatility. So keep your eye on that economic docket I have on Sunday's update. Till then, best of luck trading, guys. See you tomorrow. Cheers.